Chapter 12. The Cost of Capital. Every dollar a firm uses to finance its investment project is not free. A firm has to pay for the capital raised through debt, preferred stock, retained earnings, and common stock. The cost of a firm's funds is referred to as the cost of capital. The weighted cost of capital is an important input in the capital budgeting decision process. It is the discount rate used when computing the net present value of a project of average risk. For a project of average risk, it is the hurdle rate used in conjunction with the internal rate of return approach or the modified internal rate of return approach to project evaluation. The formula is given here, and the detailed information of this formula is provided in the next slide. This slide provides detailed information for the weighted cost of capital formula. Now, the product of the pre-tax cost of debt and 1 minus tax rate is known as the after-tax cost of debt. The interest paid is tax-deductible expenses from a firm's taxable income, so we have to consider the cost of debt on the after-tax basis. This slide illustrates the calculation of a firm's weighted cost of capital given information. The weighted cost of capital is calculated by equity fraction of capital structure times cost of equity plus debt fraction of capital structure times after-tax cost of debt equal to pre-tax cost of debt times 1 minus tax rate plus preferred fraction of capital structure times cost of preferred stock. After calculation, the weighted cost of capital for this firm is 7.5%. Practice problem. The after-tax weighted average cost of capital is calculated as debt fraction of capital structure times pre-tax cost of debt times 1 minus tax rate plus equity fraction of capital structure times cost of equity. We have debt value equal to $480,000, equity value equal to market price of $42 per share times numbers of shares of common stock, which are 15,000, pre-tax cost of debt equal to 6%, tax rate equal to 30%, and cost of equity equal to 22%. After calculation, we obtain that the after-tax weighted average cost of capital is 14.30%. Next, we would like to discuss methods a firm can use to compute the cost of its major component sources of capital, including debt, preferred stock, retained earnings, and new common equity. We first discuss how to compute a firm's cost of debt capital. As we discussed in Chapter 6, when a firm uses a debt issue to raise capital, it promises to pay periodic interest and a maturity value at the time of maturity date. Therefore, the pre-tax cost of debt is calculated as the rate of return KD that equates the present value of all expected future receipts to the net proceeds of the debt security. This is actually not a new stuff to learn. It's actually the calculation of the year to maturity we introduced in Chapter 6. Here is how you can use financial calculator to calculate the pre-tax cost of debt. The present value is the net proceeds of the debt security. Payment is the coupon payment of the debt security, a cash outflow. Future value is the maturity value of the debt security, a cash outflow. N is the time to maturity. Compute interest rate. The interest rate you obtain is the pre-tax cost of debt. The after-tax cost of debt is calculated by pre-tax cost of debt times 1 minus tax rate. We now discuss the computation of the cost of preferred stock. The cost of preferred stock is the rate of return required by a firm's preferred stockholders. From the perspective of an issuing firm, the cost of preferred stock is calculated as constant preferred dividend divided by net proceeds to the firm. Net proceeds to the firm are calculated by the price of the preferred stock subtracts issuance costs. The last computation we would like to discuss is the cost of equity. The cost of equity is the rate of return required by a firm's shareholders. Firms raise equity capital in two primary ways: internally, through retained earnings, and externally, through the sale of new common stock. Consequently, we will discuss the cost of internal equity and the cost of external equity. The cost of internal equity to the firm is less than the cost of external equity because issuing new common stock is accompanied with high issuance costs. The cost of internal equity can be computed using the models developed in Chapter 7, as well as the capital asset pricing model, the security market line, discussed in Chapter 8. From constant gross dividend valuation model, we have cost of equity is equal to expected dividend yield plus dividend growth rate, that is the price appreciation yield. I will not test you to calculate the cost of internal equity using non-constant gross dividend valuation model. Alternatively, we can calculate it through the security market line. We can compute the cost of external equity using a constant gross dividend valuation model. Note, the net proceeds to the firm calculated by the share price minus issuance costs are used. Following are two examples showing you the difference in implementing constant gross dividend valuation model to compute the cost of internal equity and the cost of external equity. We have the same current dividend, the same dividend growth rate. However, the share price is used in computing the cost of internal equity, while the net proceeds to a firm are used in computing the cost of external equity. This table summarizes formulas computing component costs. End of chapter questions. Question number 8. Be sure to read through the problem so you would know how to extract the information from the problem to perform the calculation illustrated here. The company eWin would like to find out the weighted cost of capital appropriate to use in evaluating its asset expansion program. The formula to calculate the weighted cost of capital is given here. We have the information for equity fraction of capital structure, which is 75%, debt fraction of capital structure, which is 20%, preferred fraction of capital structure, which is 5%, and the cost of preferred stock, which is 14%. Therefore, we have to find out the cost of debt and the cost of equity in order to calculate the weighted cost of capital. We can compute the cost of debt by the financial calculator using the information of the new bond issue used to finance the expansion project. We have the present value equal to net proceeds to eWin $990, payment equal to annual coupon payment $150 calculated by annual coupon rate of 15% times the face value of the bond $1,000, a cash outflow. Future value equal to the maturity value, that is the face value of the bond, $1,000, a cash outflow. number of periods equal to time to maturity 10 years. Compute interest rate. The interest rate obtained is the pre-tax cost of debt. We obtain the value equal to 15.2%. Now, here comes with a little tricky issue. eWIN only expects to have $20 million of retained earnings available to finance the expansion project. The expansion project calls for investment of $100 million. With the capital structure proposed, $75 million are funded through equity capital. Therefore, the external equity needed is calculated by total equity capital needed minus retained earnings equal to $75 million minus $20 million equal to $55 million. Consequently, we have to calculate both the cost of internal equity and the cost of external equity. Given the information we have, we will use the constant gross dividend valuation model to compute both the cost of internal equity and the cost of external equity. We have current dividend equal to $2, the dividend growth rate equal to 5%, share price equal to $15, and share price net of issuance costs equal to $14. After calculation, we obtain that the cost of internal equity is 19% and the cost of external equity is 20%. We now can compute the weighted cost of capital by plugging the corresponding value into the formula. Note, we have to decompose the equity fraction of capital structure into the internal equity fraction of capital structure calculated by retained earnings divided by total capital and the external equity fraction of capital structure calculated by external equity needed divided by total capital. After calculation, we obtain the weighted cost of capital is 17.3%. We would like to discuss the topic determining the optimal capital budget. The optimal capital budget can be determined by comparing the expected project returns to the company's marginal cost of capital schedule. This can be accomplished by plotting the investment opportunity curve and the marginal cost of capital curve on the same graph. The investment opportunity curve shows returns expected from the proposed capital expenditure projects against the cumulative funds required. The marginal cost of capital curve shows the marginal cost against the cumulative funds invested. The optimal capital budget is the point at which the investment opportunity curve and the marginal cost of capital curve intersect. That is, based on this graph, the optimal capital budget totals $23 million and includes projects A, B, C, and D. The firm should not include projects E and F because the expected returns are below the marginal cost of capital 11.35%. Undertaking projects E and F is just like the company tries to borrow money at 11.35% and then lends the borrowed amount at 11% or 10%. It is definitely not rational and would lead to a decrease in the firm's value. We are required to find out the optimal capital budget for this firm. We can obtain the solution by plotting the investment opportunity curve using the information provided here and the marginal cost of capital curve using the information provided here on the same graph, and the point of intersection for these two curves determines the optimal capital budget for this firm. Alternatively, we can prepare the table presented here. The table summarizes the information of expected returns against cumulative funds required, and the information of marginal cost of capital against cumulative funds invested. By looking at the table, we know the optimal capital budget for this firm totals $11 million and includes projects A, B, C, D, and E. Projects F and G should be excluded because the expected returns are below the marginal cost of capital. Practice problem. To respond to this problem, we have to compare the cost of capital before and after the capital structure change. So, we first calculate the cost of capital before the capital structure change. The firm currently is 100% equity financed. Therefore, its current cost of capital is equal to its cost of equity. We can obtain the cost of equity through the security market line. We have the risk-free rate of 4.2%, beta of 1.1, and the market risk premium of 8.5%. After calculation, we obtain that the cost of equity, which is equal to the cost of capital, is 13.85%. After the capital structure change, the firm's cost of capital is the weighted average of after-tax cost of debt and cost of equity, that is, the weighted average cost of capital, because the firm's beta changes after the capital structure change. We have to recalculate the cost of equity using the security market line. The beta now is 1.2. After calculation, we obtain that the cost of equity after capital structure change is 14.70%. We now can compute the cost of capital after the capital structure change. It is the weighted average cost of capital calculated by debt fraction of capital structure, which is 25%, times after-tax cost of debt, which is 6%, plus equity fraction of capital structure, which is 75%, times cost of equity, which is 14.70%. After calculation, we obtain that the cost of capital after the capital structure change is 12.525%. The cost of capital decreases from 13.85% to 12.525% after the capital structure change. Therefore, the firm should make the capital structure change. Practice problem. To respond to this problem, we will have to calculate the stock price before and after diversification. Based on the information from the problem, we would use the constant gross dividend valuation model given here to obtain the stock price. We will discuss the calculation steps in the next slide. We first find out the cost of equity before and after diversification using the security market line. We next compute the stock price before and after diversification applying the constant gross dividend valuation model. After diversification, the stock price decreases from $51.13 to $39.47. That is, the stock price drops about $11.66, so the company should not complete the diversification. Practice problem. For this problem, you can obtain the solution by applying the after-tax weighted average cost of capital formula given here. You do have to use the security market line to obtain the cost of equity first.